So you have properties in your business, or you want to acquire properties in your business. How would you account for them in your business? Essentially, if you're buying the property for rental income only, it's treated as an investment property. But if you are owning the property, so if it's owner occupied, or you're using it as a dual purpose, so let's say for example you are using the first floor for your staff members and then the second floor renting it out to tenants, that would not be classed as an investment property. In some instances, you have dual purpose, where let's say you own a mall that you're renting out on a commercial basis, but in there you have an office for your property manager. That use of your business, which is the property manager office, is insignificant compared to the rest of the mall, and in that instance you can treat that as an investment property. It's important how you treat this too, because they have different tax benefits, different criteria in terms of what needs to be disclosed in your accounts by law. So for example, if you're accounting for property in your business as an investment property, that means you can only show it at cost, unless if you are a larger business that's reporting under a certain framework in accounting, you're allowed to use the market value or the fair value method for valuing your properties. But if you're a slightly smaller business, you're likely using an accounting standard that only allows you to show this at cost. The benefit with this is that because you're showing it at cost, even when you do gain some equity or you do have instant profits from refurbishing the property, you do not necessarily have to pay the tax for this amount because you are showing it at cost. However, this tax will likely have to be paid when you then sell the property or when you dispose of it, and you're looking at the net gain in total and not just the gain in one transaction. So that helps you if you're scaling your properties, because it means you can add on more properties and offset all sorts of profit against losses in your limited company and pay the tax on the net taxable amount when you dispose of the properties. If you are using the property as an operational property, you will get tax benefits. So likely you will get tax benefits by claiming what's called depreciation or amortization on any of the properties as you go. Typically over a period of 5 years, you are spreading the cost and claiming all sorts of costs against those properties, and that reduces your tax relief. Now, if you're treating this as an investment property and you are still showing it at cost, which you should, that doesn't mean that you shouldn't know what the fair value is. So while it's not shown on your balance sheet, you still have to disclose what the fair value of that property is to enable other readers of your financial statements to understand the true value of your business or of your properties, but also because it is a requirement in terms of how company accounts should be structured, and you will show there what the basis of that investment property is, even though you're not claiming any gains or you're not paying any taxes on that gain. So just make sure you're having conversations with your accountant in terms of the use of your properties, so they know exactly how to account for your properties and maximize the benefits that you can get from the right structure for your business without actually going against what the rules should be. I hope that was useful, and if you have any comments or any experiences, if you have treated this in the incorrect way, drop me a comment or a DM and I'd love to chat. Thanks.